All right. I think we're live and I think we're going. Let's see. Let's see. Cool. All right, let's wait. Let's give it another minute. Let's get some people, let's let people get settled. I see people trickling in. Nice. Cool. Well, thanks everybody who's here so far. Thanks for coming on and taking the time. I see this number still going up, so we'll give it another minute or two before we get into it. But in the meantime, for the people who are here, thanks so much for joining. Really excited to have you on board. My name is James Kuttner, and I'm the sales team lead here at Doorvest. Today's webinar is called Real Estate Investing for Beginners, and we'll be talking about how you can invest in single-family rental homes by partnering up with us. So let's see, we still have the count going up a little bit. Let's see. My speaking portion, it's going to take around 20 minutes, after which point we'll go over some questions. We'll have some Q&A. So feel free to keep submitting questions while I speak. We'll get to as many questions as we can afterwards. The goal is that you'll know everything you need to know about getting into real estate investing with Doorvest by the end of this. So please feel free to ask any and all questions. But let's see. Okay, just give it another minute. I still see people trickling in. Yeah, thanks so much though for the people who are here. I don't know if you guys can tell in my background, it's a beautiful sunny day here. So you can see the sun coming in. I'm in sunny San Diego. I hope everybody else is not in too terrible of weather. I'm sure we have some East Coast people joining us though. Let's see, and if that's the case, then okay, yeah. Let's see. Walker French said how many people are on. About 76 people are on so far. Iman, thank you so much. Thanks so much for joining. Happy to chat about how we can help. You guys wanted to pop in the chat too, where you guys are based out of. I'd be curious if anyone's coming out of San Diego or SoCal. I'm in Carlsbad, San Diego. So feel free. San Francisco. Okay, cool. Texas, cold. Arizona, nice, very cool. Okay, cool. All right, we're at 80 people. Oh, LA, okay. NYC, okay. Do we have anybody here from DC area, Washington? That's because this is where I was. I grew up basically. DC. There we go. DC. Annie, thanks so much. There we go. Cool. Okay, I see some familiar names here too. So for the people who have already spoken to, I hope that you get something else out of this as well. We are going to be diving into things a little bit more in depth here, rest assured. And then also for the people who are coming on for the first time, happy to meet and happy to get this going. Okay, cool. All right, awesome. I see Irvine. There we go. Represents SoCal. Cool. Okay. Nice. We'll get this going. I'm sure people are going to be trickling in, but yeah. I mean, thank you guys all so much for hopping on and taking the time and joining me on this beautiful day. This is awesome, and I hope we can make this an enjoyable and informative kind of session. Well, as I was saying before, super quick speaking portion. We'll get through. I'll get through what I have to say in about 20 minutes. We are going to be going into depth about real estate investing for beginners, why real estate, what exactly Doorvest does. We will also have a Q&A afterwards. Feel free to keep submitting questions. I have Maggie Zing with me here, who's going to be looking over them, and she'll be feeding them to me after I'm done speaking. And yeah, we'll get through as many questions as we can. But let's hit it going. So nice. As I mentioned, my name is James. I lead the sales team here at Doorvest. I also help out around some other parts of the company. I come from an accounting background. I do a little bit of like product here, a little bit of marketing, mostly sales, but most importantly, I'm a real estate investor. I think that's the most applicable. I love real estate, which is why I'm super happy to be working here at Doorvest. On a daily basis, I help people get into real estate investing for the first time, and I get to see people can reach their financial goals when it comes to real estate investing, which is, it's really, really cool. So this brings me to, here we go. This is Doorvest, our mission, democratize financial security for everybody, starting with real estate. Yeah, I mean, why real estate? That's a very good question. This is what I get asked by a lot of people. I mean, it's always kind of well known that real estate's a really good investment vehicle. Nobody really kind of doubts that, but why exactly is real estate good? What makes it so different than other kind of asset classes? And why is it really, why do a lot of people want to get into it? And number one reason I find when I talk to people is the financial freedom it can provide. Real estate's the type of thing where you can do it on the side while you work a 9 to 5, while you run a business, while you do X, Y, Z. And the idea is that eventually you can transition to a point where that's all you do. You can get out of your 9 to 5. You can go only into real estate. It's another income stream if that's your goal. And the reason for this is because real estate is what's called passive income. And what I mean by that is yes, real estate investing takes work, but it doesn't have the same work to income ratio as, say, a salary job. In real estate investing, there's startup costs and effort required. There is always going to be ongoing work throughout the whole life cycle of the home and the investment, but it doesn't require the same constant input as, say, like a 9 to 5. You go into your 9 to 5, you punch in, you punch out, you're working consistently, hopefully while you're there, and then you go home. But it takes that constant steady input, and real estate doesn't take that by any means. If you set it up correctly, if you kind of do everything that you should or you're supposed to do, it can be kind of a set it and forget it, which is part of what makes it so attractive. But real estate is also, it has a very specific kind of profile as an asset class, which allows you to do this versus something like the stock market. What I mean by that is real estate has very specific qualities that lend itself well to long-term wealth building. First of which is real estate is tangible. It has intrinsic value. And in fact, this is called the replacement cost of your home. That's the intrinsic value. And also, with a home purchase comes the land that it sits on. In addition to being tangible, land is also a finite resource. And so not only is like the home and the land that it sits on tangible, but it also serves a very important use. It's a home, it provides shelter. A well-built home can last hundreds of years. Shelter is a need. There's a very large market for this. Unsurprisingly, about 65% of Americans own a home. That means if you decide to sell your home, you're not just selling to other real estate investors, you're selling to the broader population as well. So all these factors, they contribute to the two main trends that you see in real estate or in home prices, which is one, they're very, very stable. And two, over time, they go up and to the right. They appreciate. And in fact, home prices have gone up every year in the history of the United States with very few exceptions. And on average, they go up more than inflation, which is why real estate is referred to as a hedge against inflation. And all this is not even counting the fact that, you can rent out your home and receive cash flow. I see. Yes, this session will actually be recorded and sent out. We appreciate you hopping on for the brief time that you have, but we'll absolutely get this out to you after. That goes to anybody else too. But so, yeah, I mean, so that's one of the biggest things is not only does the home price appreciate every year, but you can rent your home out and receive cash flow. And that's really what makes real estate turning into like a kind of a remarkable investment. And that's where you're able to really see the ability to build wealth. You can rent out your home. That rental income can cover all your expenses associated with operating and maintaining your home. And then you can have some left over. And that leftover cash after all expenses is what's referred to as cash on cash returns. It's essentially your cash in your pocket after all expenses. And so the idea is that your rental income covers your mortgage payments. You only put about 20% down, typically on an investment home. You put your down payment, you're not buying the whole home. This is what's referred to as buying your home on leveraged. And then your rental income pays off the rest of your home over time. and then you have cash in your pocket. And then year over year, you're amortizing your mortgage, you're paying down your mortgage. Year over year, rent is increasing. Year over year, your home appreciates. And all of those things coming together is what gives real estate the really interesting profile that it has. That's what makes it so good at building wealth. And kind of above all else, investing in real estate's really, really fun. It's a very cool thing to do. I really, really enjoy it, which obviously is why I'm doing what I'm doing. But it's fun. Like I remember my parents would always have me like driving around, on like Saturday and Sunday mornings, going to check out homes. We would like go and like hop on like Zillow and like check out the different prices of homes. And it was a cool activity to do. And so I still kind of do that, whenever I check out a new place. I'm certainly going to probably be doing that with my kids too. And it's overall, I mean, investing's fun, real estate investing's fun. It has the potential to build wealth, lets you reach financial independence, live your dreams, etc. I mean, I think that's hopefully why you guys are all here joining me today. So with that, why now? This is a very valid question. Why now? Three things have really come together to make now an interesting time to invest in real estate. Overall, what you'll hear when you do any research is, and I'm always a big proponent of this, is time in the market is more important than timing the market, always. So if you look at the last 100 years, it's always a good time to jump into a real estate investment. Being in real estate for any length of time is more important than trying to time it at the right point. That said, now is a very good time to invest in real estate for a couple of reasons. One is interest rates are super low. This is essentially one of the cheapest costs of capital that we've seen. Interest rates are at all-time low. The Fed signaled that they're going to stay that way for another couple of years. This has pushed a lot of people into buying up investment homes, trying to seize that opportunity. The next is kind of a social. Basically, more and more people are renting out their homes. The drivers for this is people really, really need to be flexible. They need to move around, switch companies in order to get promotions. And with that, we've seen about 40% of increase in high-income renters over the last decade. Which is significant, and overall one of the bigger drivers for more people renting out their homes. And then the last is technological. Essentially, this is the easiest it's ever been to buy and own single family rentals totally online, virtually in another state, as passive as possible. As I'll get into later about like how you actually go about investing in real estate. It's not trivial to do, and you can kind of multiply that by a magnitude of 10 when you're trying to do it to an out-of-state home. And this is essentially, where Doorvest comes in. Is we leverage technology to help you own, single-family rentals in the easiest way possible. So there we go. That gets me to my next point, which is why Doorvest. And basically, this is where I'll get into exactly how investing with us works, how you would go about investing in the traditional methods, what the exact difference is between us and going off and doing yourself. And really the idea is that we've leveraged technology to make investing in real estate as easy as possible. I mentioned earlier that investing in real estate or real estate in general, so it's known as a passive investment, meaning once you get it going, if done correctly, it doesn't require that constant daily, input like working on a 9-to-5 or running a business. But that's not to say that finding and owning and operating rental homes is easy or doesn't require skill or knowledge or experience. You might have to allocate 5 hours a week, 10 hours a week, etc. To really get everything kind of, maintaining on a course that you want it to go on. And a lot of people just don't have that. They don't have the time with their busy work, careers, family, or they don't have the expertise to go off and do it themselves. You'll make mistakes. Those mistakes will cost you time and money. And yeah, I mean, that's basically where Doorvest comes in. So I'll kind of lay out what it takes to own a rental home and then kind of go in exactly how Doorvest helps. The overall idea is that we are what's called a turnkey provider, if you like research that term. We do all that upfront necessary legwork to get you a rental home. We take care of the long-term property management after the fact. You just essentially choose a home with us, and then we go on and take care of the rest. And so kind of exactly what this entails is, what does this look like if you went and did it yourself? What does it take to find and own and operate a rental home? Basically, logistically, how this works, what knowledge do you need to have, what expertise do you have, how would you go off and do it yourself? And this is what I'll get into now. So basically, if you're getting into a single family rental home, the first thing that you would have to do is analyze deals. What I mean by that is you need to go off and find different potential deals, find different potential homes, diligence them to make sure it's a good deal from a financial standpoint, make sure that the home makes sense structurally, that it's in a good neighborhood, good schools, etc. And what this entails is building up a network to source these really good deals, running analysis on the market and the neighborhood, running analysis on the home itself, predicting renovation costs. And that can be pretty tough and time consuming, especially if you're just getting into a new market you're not familiar with. It really does take some work to make sure you're not making a poor decision when it comes to the home and the deal, the market, etc. You can look for homes on MLS, which is the multiple listing service. That's where just kind of the traditional route you see where most people go to sell their homes. It's on like Zillow or Redfin or whatever. Or you can go and you can build up a network of off-market homes, which comes from wholesalers, auctions, foreclosures, short sales, all these off-market ways that you wouldn't find a home just kind of on the traditional MLS side. And in fact, most home transactions occur off-market. When you're looking at the MLS, the multiple listing services, that's a small fraction of the total number of homes sold in any given time period. So if you were going to go do this yourself, don't limit yourself necessarily to one avenue. You would also want to check MLS, but you would want to go and expand basically your sources. You would want to go find networks of wholesalers, introduce yourself, build relationships, go check out different auctions, go check out, where like people are short selling homes, and you would want to pull from as many different pools as possible if you're going off and analyzing deals yourself. And then, like I said, from there, you want to make sure that the home you're getting is in good shape. Typically, you want to avoid any major like structural foundation issues when it comes to like plumbing, electrical, foundational, etc. You want to make sure that you're in a good neighborhood, you're in good schools. This is what's going to attract quality, long-term focused residents. And so that's kind of the idea of upfront. And so you do this, you kind of hit the pavement, analyze different deals, you find the one that you really like, and then you make a bid on it. And then, you either win it or you don't. But that goes to the next step is, you put in your bid. Let's say you have a winning bid, you win the home. You purchase the home. What's next after that? And that gets you to the renovations, essentially. So at this point, you need to find and vet contractors, oversee the work, sign off on it. There are multiple services that allow you to kind of browse different contractor networks. You can even like meet and greet with them online and get a sense of how they are, like their work, their profile, what they do, what they charge. But it is trial and error to a large extent. You'll be able to try it. You'll do some work with one of them, and you'll see if the work they did is sufficient or not. And hopefully it is. But then they do the work, and then it's you go and you find and place a tenant. You market the home out. There's also tenant listing services that allow you to do this. And then you manage the home on an ongoing basis. You become the property manager. And so that's where you are kind of on call in a sense. Like it's like I'll keep going back to the point that real estate does not require a constant, steady input like a 9-to-5 job does, but you are on a call in a sense that your resident will call you up if something's going on wrong in the home. They'll give you a ring. You have to go and you have to fix it. You should be pretty prompt about it if you want to keep them happy. And that's all kind of a function of, did you diligence the home correctly enough? Did you do good enough work? All of that will impact into ultimately how much work, ongoing work you have to do as a property manager. Yeah, that's essentially a quick overview of how you would go off and do this yourself. And then now we'll get into basically how exactly does Doorvest do it? What exactly do we do? How exactly do we kind of approach everything? Um, and Let's see here. I see people still sending some questions in. Recording, yes, absolutely. We will absolutely get a recording. Fees, contract, commitments. Please post all of these questions into the Q&A and we'll absolutely go through all of them. Hey, Chris, agreed the power of compounding over time. Absolutely. Very good to see you as well. So yeah, so kind of how it works, the high level view is, like I mentioned, we take care of all that initial upfront legwork. We take care of the property management after the fact. You start off, the whole process kicks off basically by arriving at the game plan of what an investment home might look like for you. So price point, return expectations, risk profile, etc. Basically, the idea is we operate within a price range of about 135K minimum and about 220-ish ceiling. The ceiling is not so well defined, and I can get into exactly why later, but the idea is that within that price range, your returns, your risk will all be a function of where you kind of lie on that spending curve. So first step is determining with you what you're looking for. Are you looking for a less expensive home that'll see higher cash flow? Are you looking for a more expensive home that optimizes for more appreciation? And with that game plan, essentially we'll go off and we'll do the sourcing and the diligence for you. So we'll go pull on our network of relationships. Ultimately, we pull from all sources. We pull from on market, we pull from MLS. Oops. We pull from on market, we pull from MLS. And sorry about this, guys. There we go. We pull from on market, we pull from MLS, and basically we'll go off and we'll do the diligencing on these homes. We'll make sure it's a viable option for you, and then we'll shoot them over to you with our analysis of the schools, the neighborhoods, the kind of the breakdown of the financials, what you'll see with all your operating expenses, what rent you'll be getting, what the quoted purchase price is. And then you just give the thumbs up or thumbs down on all these homes as they come. So it's ultimately your choice which home you want to move forward with us. We'll just present you with all these diligenced, viable options. You choose which one you like. And then basically once you give the green light on it, we'll move forward with the renovation process. So let's see here. Yeah, so we'll go forward with the renovations. The hard kind of parameters for us is we're always looking to do extensive renovations. Our average reno cost that we're doing is about 30K. And this is for a home that ultimately ends up being priced at about 135K to 220K. So you can see that's a significant portion of the home's initial purchase price. We'll go up to doing 50, 60K reno jobs. Sometimes we'll be a little lighter, maybe like 10K, but our average across the board is about 30K. And the goal is that we're doing extensive renovations with the objective of giving you a home with as little deferred maintenance as possible. So you'll have a home where the HVAC, the appliances, all these things have, brand new, shiny, 15, 20 plus year lifespans on them. And you're not going to have to worry about maintenance for as long as possible. That's kind of the idea. And so we'll do these renovations. We'll kind of help you line up financing, line up insurance concurrently with the renovations. We'll kind of prep you for what's to come in the transaction, and then ultimately we'll become the transaction coordinator, basically taking you through the close of your home. So for the people who have bought a home before, they know buying like the actual transaction is a very involved process, coordinating between multiple parties. And so that's another point that we step in. So we make sure milestones are being hit. We make sure that this transaction will go smoothly. We'll make sure that we get you to close in a timely fashion. And once you sign on the dotted line, then we become the property manager. And so a little bit and more in-depth view in the process, but I'll now break the process down into these three components: the home selection, the renovation, the property management. I'll kind of get into each one with some more specificity. And then I'll tell you kind of how we go from here. And then I think we'll open up the Q&A. So not too much longer, and then we'll get to you guys' questions. But so for kind of section number one, home selection, how exactly does this work? What should you be looking for? What are the trade-offs? What do we typically see? You know, as I mentioned, we operate with homes in a price range of about 130K to about 220K. The average price point across our portfolio is 160. And so the reason being with this is that the levers to pull, or the trade-offs, is that on a lower priced home, you see higher cash flow. This is because your rent is a greater proportion of your home's purchase price. When you go up the spinning curve, you go to a more expensive home, you see that rent become less proportionate to the home's purchase price. You see lower cash flow, but the home's more expensive, so you get higher appreciation. The idea is that a more expensive home will be in a better neighborhood with better schools, will attract more reliable, longer-term focused residents. So it all equates to higher priced home, less risk, less cash returns, lower priced home, vice versa. And so the reason why 160s are average is because that's kind of the sweet spot within our price range. It's the middle of the road. It kind of combines the both best worlds. And with that average price point, we're seeing about 8% cash returns, which is about $200 to $350 net in your pocket each month after all expenses. And specifically, that's your mortgage payment, insurance, property taxes, management fee, HOA fee if applicable. Net all of those expenses, it's about $200 to $350 in your pocket each month. And then if you wanted to dial the returns up as much as possible and go to a less expensive home, you could see about 11-ish% cash on cash returns. And then if you wanted to, obviously go for a more expensive home, the cash returns would drop. And I mentioned earlier that the price ceiling we operate in is not, it's not a hard ceiling. The reason for that is essentially we would have no issue going as expensive as anybody wanted. It's just at a certain point you reach the point where the home stops being cash flow positive. Essentially, your rental income is not going to be enough to cover all your expenses as you keep going to a more expensive home. This typically happens at around 240, 250K within our price range. We do have some investors that are okay with this, that want a very expensive home. They know that they're either going to be breaking even or even cash flow negative, but they're looking for other reasons for those more expensive homes. Namely, they just want to optimize purely for appreciation. They don't care if they have to pay out of pocket, every month or maybe a couple of times a year. But most of our investors are interested in being cash flow positive, buying a home on leverage, having your rental income cover, all your expenses and pay down your mortgage, which is why the majority of our investors operate in that 135 to 220-ish K price range. So yeah, I mean, basically, if you want to get started with us, it entails either one, you can input your buying criteria in a link that we can send out if you're confident and know exactly what you want, or we can have like a at-length conversation with one of our representatives to kind of drill down into what price point works best for you. Like I said, this is all dependent on what exactly you're looking for, how much money you want to put up, obviously, but what returns are you shooting for? What's your overall strategy? Do you want to scale your portfolio up as quick as possible? Does that mean that means you want as short of a payback period as possible for your down payment? Do you want to only get a couple of homes and you just want to optimize for reliability and passivity? All those things come into play on what kind of works best for you. And so it's totally up to you. You could talk with somebody like one of our representatives and figure that out, or you can just kind of shoot it to us and initiate the process that way. But basically, we work with you to determine your price point. That kicks off the process. And then the context kind of for all of these numbers. So why the price range? Where exactly do we operate geographically? The context for these numbers is we operate exclusively in Houston, Texas. So this was kind of the market that we bubbled up to the top of our short list in terms of best rental markets. We chose to go into Houston for a variety of reasons, but that is where we operate, and that's where we're seeing essentially this price range that we operate in. It's kind of the sweet spot in price in the Houston market. Specifically, you could classify that price range on the overall the homes that we target in a term, and that term is called a rental home in an owner neighborhood. Essentially, it's an investment home that doesn't look like an investment home, doesn't smell like an investment home. It's a 3-bed, 2-bath, 2-car garage American dream home in a good neighborhood with good schools. And that is a very specific home profile at different price points, market to market, city to city. And within Houston, it's at a very attractive price point, that price range that I mentioned of about 135K to 220-ish K. And then in addition for that, other reasons why we chose and really love Houston is it's a very hot market. I mean, Houston, Texas in general is very hot. Austin, Dallas, Houston's no exception. It's got strong population and job growth. It's got, to throw some facts and figures out there for the people who want it, it's got the second highest engineers per capita outside of the Bay Area. NASA is there. It's got the 4th highest number of Fortune 500 company headquarters. It's a very landlord-friendly state in general, which we think is beneficial. And then all those things have kind of flowed together to make Houston the spot that we chose to get into. And and so basically, step number 2, renovation. You selected your home, you kicked off the process with us. We start sending you different potential homes. You give the thumbs up or the thumbs down, as I mentioned. You can talk through each home with us. Your feedback will help us iterate the search as we move forward. But what happens after you give the green light on the home? At this point, we start the renovation process. And so I mentioned before that our average reno cost is about 30K. And that's pretty substantial. And the reason being is that we're always looking for more distressed homes. And that's for 2 reasons, really. One is that by buying distressed homes, we get a really, really good deal that we can pass on to you. And then 2, I mentioned this earlier as well, as we look to do these extensive renovations because we want to give you a home with as little deferred maintenance as possible. So if we're going to be going in and gutting and replacing a lot of stuff anyways, it makes more sense to go for a more distressed home where that's warranted. And so that's ultimately the reason why. And that's what the flip is called, basically. That's the mechanics of flipping a home. Is you buy a distressed home for a really good deal, you do a ton of work into it, the valuation of the home then jumps significantly, and you could ultimately sell it and make more money than you initially put into it and bought it for a profit. That's what a flip of the home is. So essentially, we're utilizing that on the front end by buying distressed homes, doing a lot of work. We see that huge jump in valuation, and then ultimately you're purchasing the home for us below that jump in valuation or below after repair value. But I'll get a little bit more into that in a second. But essentially, we do the renovations. The renovations are very standardized because, as mentioned, we've done this a lot. We have the data to know what materials are the most cost effective, what are the most durable, what are the most attractive to long-term residents. That standardization gives us buying power, which we can pass on to you. So the renovations are very standardized. That said, as you're choosing homes, as we send you the home analysis, what's included in that is the scope of work, the estimated renovations. So if you want to look for a home that has more or less reno to it, that's totally your prerogative. You could shoot for a home where it has an extensive scope of work, or if you're okay with the last one, that's totally up to you. You get to ultimately, like I said, choose which one you want to move forward with. We'll do the renovations, and then, as I said, walk you through to close as we're the transaction coordinator, and then we'll step into the property management role. So for the property management, this is, I think, one of the most important aspects of the investment life cycle. The property management can make or break the entire experience. Property managers are essentially the gatekeepers to your investment being either truly passive or a really, really stressful experience. And so we do a number of things differently at Doorvest. The first of which is we provide 2 guarantees. So one is we guarantee rents for the entire first year. That means you start receiving income immediately. We'll always give you the home with a paying resident in place, but we still guarantee rent from the close date for a year. And so if at any point during that first year, a resident leaves, the resident stops paying, we'll pay out the rent in full. You'll receive the full year of rental income uninterrupted. Guarantee number 2, also for 1 year, is our maintenance guarantee. We say that we'll guarantee no maintenance on the home for 1 year. This is because we stand by our renovations and our initial diligence when sourcing these homes. But you know, home ownership, being a property manager, that relationship that extends much longer than a year. So what happens after that year? And then basically this comes into how and why exactly we've structured the whole process and how and why we structured the property management. So, and this will also get into the fees, which I've noticed a couple of questions earlier too. So overall, we charge, there's 2 revenue streams total for Doorvest. We only make money in 2 ways. Revenue stream number 1 is our management fee. It's 15% off your gross monthly rents. And the idea is that we charge no hidden or layered fees ever. It's just that higher flat fee. And so this is where a lot of other property managers get it wrong, is that now they're incentivized for maintenance and turnover to happen because they charge additional fees for resident replacement, for maintenance work, whatever. Now you know that they want that stuff to happen. So we did away with all those additional fees. We just charge that higher flat 15% fee. We charge no maintenance markups, no resident placement fees. That way, you know, we're not incentivized for it to happen. So basically, in regards to turnover, if a resident leaves after that first year, we will manage the home for free and then replace the resident for free. That way, you know, we want to get somebody in there as quick as possible. If maintenance happens any longer after that first year, then we will organize taking care of it. We're a full service property manager. We handle fixing the maintenance, but we don't mark it up in any way. You receive it at cost, which means we can pass on the buying power we get with our contractors to you. And then ultimately, the overall parameters for both of those is do the proper diligence up front, do the right work, do the right renovations to prevent maintenance down the line, and then place really, really good residents from the get-go. And so that overall is the most important thing, is to just mitigate this from the very beginning. And so our property management is done completely in-house by Doorvest employees. We don't contract it out. That's part of the reason why we've been able to structure it kind of as we have. And so we are absolutely very, very proud of that fact. And yeah, that's essentially the two revenue streams for us. So I think at this point, I see we're kind of getting close to the wrap-up time. So let me go over to the Q&A and let's answer some questions. So, okay, let's see here. I feel free to keep sending in questions. Absolutely happy to chat. We'll stick around here and answer questions for a little bit. I also wanted to say thank you guys all for hopping on and taking the time. This has been really great, and we'll see if we can answer some questions. So let's see. Will Doorvest move outside of Greater Houston? Yes. Expansion is a priority for us. We chose Houston as our initial market to jump into because, like I said, this bubbled up to the top of our short list in terms of best rental markets. Expansion is a priority for us. So we can't disclose exactly which market or we would be going into, but as I mentioned, that's definitely top of mind for us. During the home selection process, is there a fee? Absolutely not. So do you mark up the renovations? Okay, those are 2 questions. So yes, I mentioned earlier there are 2 revenue streams total for Doorvest. Revenue stream number 1, as I mentioned, was that management fee, which I went into at length. Revenue stream number 2, and the only other way that we make money, is a one-time 8% transaction fee on the sale of the home to you. So it is in effect a markup on the home's final purchase price. So it gets 1, rolled into your mortgage and finance. You're not just cutting us a check for it. 2 is anywhere you see a quoted home price from us. when I was mentioning earlier that our average was 160, when I earlier said that our range was 135 to 220, those are always be inclusive of that 8% markup. So you'll never see it. You'll always see the final home price of what you have to pay. Always will be inclusive of that markup. And the way it kind of works mechanically with that markup is, the goal is that even with that 8% markup, you're still purchasing the home not only at a fair price. Obviously, we could not and would not oversell you the home, but you're still purchasing the home below after repair value. Reasons we're able to do that is, one, like I said, because we get really, really good deals. Two is because we get economies of scale with our contractors. And then three is that the flip of the home, by buying a distressed home, doing all that work, that's where you see that huge jump in valuation. That final jump in valuation is called the after repair value. And so the idea, the way I always frame it is, we're taking an 8% cut out of that spread, out of that jump in valuation. So jump in valuation, ARV is up here. We're taking our 8% cut here. You still are buying the home below market value, or you get that discounted market value, which is that. And then the control is that your financier, your lender will order an appraisal that will support or not support the home's purchase price. That's control number one on making sure you're getting a fair price. Control number two is that we're transparent about everything throughout the way. We're transparent about what we purchased the home for, what dollars went into the renovations, what comps are. We're always happy to show you the source documents, the contracts, the invoices at any point of the process. You can track how and where each dollar went where. And so, yeah, that's how we handle the purchase. Those are the only two fees for Doorvest, or the only two ways that we make money. Okay, let's see. Let's see some other good questions. And feel free to keep sitting any questions in the chat. Let's see. I see reference 8 to 11% cash on cash. Does this include downtime from purchase through renter? Over what period of time? That's a great question. This is that's annual. That's 8 to 11% cash on cash returns annualized, starting from the day that you close on the home and exactly 12 months out from that. That's a very, very good question. Do buyers have control over the leasing agreement? How are applicants screened? And do you provide any property updates periodically? What is your eviction process? These are all very good questions. Let me get into all these. So, do buyers have control of the leasing agreement? Yes and no. So, to be pursuant to fair housing guidelines, we have to maintain most of the control over it. There are very strict compliance and regulatory concerns when it comes to placing a resident. That's why we handle it. How our applicants screen, though, basically we have one of the more stringent underwriting processes when it comes to screening these applicants, still pursuant to fair housing guidelines. So specifically, we look for 3x income to rent, background, criminal history, credit checks. We do look at the people these residents holistically, and you do have control in the sense that you can, ask that we rent it out for higher or lower, ask that we rent it out more aggressively or less aggressively. But when it comes to actually selecting the tenant, we have to take the reins there. How do you provide property updates periodically? Yes, we do biannual home inspections. And then what is your eviction process? So we handle the evictions. That's a worst case scenario. Like I said, our goal is to mitigate that and minimize that as much as possible from the get-go. If it happens, we take care of it. And also keep in mind that in Texas, forcible removal is on the table. So I think having that be an option has mitigated it a lot because it is in the back pocket. But like I said, the most important thing is minimizing that as much as possible from the get-go by our home selection, by our resident replacement, by being really, really good property managers and keeping our residents happy. We shower with them with gifts. They also get a designated point of contact. They get an account manager essentially, as would you. And so everything goes into minimizing that. If it does happen, that's terrible. But yes, we would absolutely handle, we would take care of it. Okay. How do you handle insurance, both liability and homeowner? That's a very good question. Overall liability insurance is, I think, the most important, but we can introduce you to our insurance partners. We can walk you through the process, help you tweak, help you understand what kind of is the best way to go about that. Ultimately, there's no restrictions on who you get insurance, your level of coverage. It's totally up to you. We can provide guidance, but there's no restrictions, and there's also no restrictions on the financing portion as well. Same thing, we have partnered lenders we can introduce you to. We can walk you through the process, but there's no restrictions. You can go through any lender or any method of financing that you want. So it says, how many properties do you guys currently manage? That's another very good question. So we're not currently disclosing the number of doors or homes that we have under management. We are disclosing that we have about $20 million worth of assets under management, all within the Houston MSA, but we're not disclosing the exact number of doors. Okay, let's see here. Okay, this is a very good question. Longevity of startups is a concern. What happens to a management company if our company is not around? What happens if Doorvest goes under? That's a very, very good question. So the way I frame it is this. You're right. I always tell people that we're not poised to go under anytime soon. We have a significant amount of assets under management, as I said. We also operate an opportunity zone fund, which is another source of revenue. Just shows the flexibility of our model. We are venture and angel backed. That said, for contingency's sake, what if we go under? The way I frame it is, you would still have an awesome, newly renovated rental home in a great market. You would just lose our awesome service. But the value that we provide is not just in our property management. It's finding the home, doing the diligence on it, doing the renovations, putting a really, really good resident in there initially. And so you would lose our property management service if you went under. But like I said, you'd still have a high cash flow, great home in a great rental market that will appreciate. And we would just transition you to another property manager. So that's the way I frame it. It's definitely worst case scenario, but it's a very, very good question. Okay. Let's see. What's the average cash on cash return? Just in case anybody joined late, average for us is about 8% within our price range. You can dial that up to around 11. Excuse me, if you want to go for a lower priced home. Can you share more on the Opportunity Zone Fund? That's a great question, Will. And please feel free to email me more questions about it. Short answer is it's not currently open to the public. We're working on that. It's another very complex, there's a ton of regulatory compliance concerns around it. So we're trying our best to get it pushed out, but it's not currently open to the public. But definitely happy to answer more questions about that as well. Let's see here. Okay. And please feel free, any other questions that do not get over to us. We'll be sending out an email after this to allow you to do a couple things. One is, if you're not a Doorvest user, it'll allow you to start the process in a couple of ways. It'll allow you to start the process, one, by just putting in the $500 deposit if you want. That'll kick the process off. And then one of our reps will be contacting you to basically help guide you through it from there. Or they'll give you a link which allows you to schedule a time with one of our reps who can help answer any additional questions that you have. For the people who are Doorvest customers, please feel free to send these questions to me, to anybody at Doorvest. Absolutely, I'm always happy to answer any questions. I'm always happy to hop on chat live as well. Even though I'm losing my voice, I'm going to drink some water real quick. So let's see. What is the tax situation in Houston? What is the average? What is the exact amount of tax? Okay, so that's a very good question. Tax can be a killer for cash flow. That's absolutely right. So average property tax rate for Houston is about, it ranges from 2 to 3%. Obviously, on the lower end of that range, you'll see higher cash flow. That is significant. Texas does have high property taxes. That said, even with Texas's higher property tax rates, we're still seeing on average 8% cash on cash returns. And this is due to basically that sweet spot in terms of price range that we're looking at. And though Texas does have high property tax, it does not have any income tax. And that won't affect you necessarily unless you reside in Texas. You'll still be paying income tax on your rental revenue in the state that you reside in. But what it does do is it contributes to the overall quality of the rental market. This is one of the reasons why there's a lot of job and population growth into Texas and into Houston. It's because it doesn't have any income tax. It's a very attractive, makes it very attractive for people to want to move there, for industry to want to move there. That's part of the reason why it's been booming. But yes, Texas does have high property taxes. Will this session include Doorvest inventory homes for sale? That's a very good question. So essentially how the process works is we don't show you the potential homes for you to actually purchase until you put in that $500 deposit. And for some more information about that, that $500 deposit is fully refundable at any point you have questions asked, or it gets applied to the home's purchase price. It's basically our way of weeding out the less serious people. But it's a soft commitment because you can always request it back. It's always refundable. So basically you put in that deposit, that kicks off the process. We always start showing you different potential homes for you to purchase. But before that, if you want to contact one of our reps, schedule a time, we can send you as many of our previous homes as you want, basically. No problem there. I'm happy to go over any other questions. So, okay. See any other questions? Question on how you all think about your fees in your model and what return expectations are net of fees. So that's another very good question. And maybe not the last question I can do. Maybe I can do one more after this. So because we are coming up on the hour point. So in our cash flow breakdown, we include your rental income net of mortgage payment, insurance, property taxes, HOA fee if applicable, Doorvest servicing fee. The two things we don't include a maintenance reserve and we don't include a vacancy reserve. Reason being is that every part of our operations was designed around mitigating both those concerns, maintenance and vacancy. So that's why I touched on it earlier too. This is why we look for the homes that we look for, do the extensive underwriting that we do, the extensive renovations that we do, all to minimize maintenance. That's why we do the vetting for residents that we do, all to minimize turnover. That's why ultimately we don't make any money on either turnover or maintenance. So you know right off the bat that we're not incentivized for it to happen. And so every part of our operations, like I said, was designed around mitigating both those. We don't include a reserve. That said, we're essentially with that approach, we see about 3% of the home's gross, 3% vacancy is our vacancy rate. So if you wanted to bake that in, you could bake in 3% vacancy. You could bake in the fact that we also don't charge our servicing fee during periods of vacancy. But that's the reasons why we don't include those things in our cash flow analysis. But that is a very, very good question. Okay. Okay, this was really great. I think we are going to have to wrap up. I see we have a couple of minutes left. I think people are dropping off the chat or dropping off the webinar. So we will be wrapping up. Thank you guys all so much for hopping on and taking the time and joining with me today. This was really great. And I think we put it out in our marketing materials that this was our first webinar. I don't know if I mentioned it, but this is our first webinar. So thank you guys all so much for hopping on and for taking the time and for the really, really great questions. I'm sorry I didn't get to answer all questions. I see, can we invest in an LLC? Yes. Totally fine if you invest in an LLC. I can answer this one super quick. No restrictions on us. That's totally okay with us. But yeah, thank you guys all so much for hopping on and taking the time. And hopefully we can be doing a couple more. And I hope to have some more conversations with a lot of you after this. But yeah, much thanks. And I hope you guys all take care and enjoy the rest of your evenings and your day. I appreciate you guys sharing a portion of it with me. So take care. Thanks so much and talk soon. Bye-bye.